Responsibility in provincial policy can be gauged by the extent to which a government insulated public finances from the commodity cycle, preserved or enhanced the long-run tax base, and maintained growth in real output that was at least commensurate with world economy trends. Judged against those criteria, the Notley government, 2015-16 to 2018-19 stands out as the most disciplined of the past 5 administrations. When West Texas Intermediate collapsed from more than $90 to the mid-$40s in late 2014, Alberta's resource revenue fell below $5 billion, barely 1/5 of its 2005 peak. In the first full NDP budget, the deficit reached 10.8 billion Canadian dollars, equal to 3.2% of GDP. The government responded by raising the top personal income tax rate, restoring the 12% corporate tax rate, and introducing a broad-based carbon levy. Together, those measures lifted non-resource own source revenue by roughly 2 percentage points of GDP over 4 years. As the new revenues matured, the consolidated deficit narrowed to 6.7 billion Canadian dollars in 2018-19 despite only a modest recovery in oil royalties and despite the decision to continue capital spending at $6 to $7 billion a year to support the private sector rebound. In structural terms, the consolidated balance net of resource royalties, the gap fell by about $4 billion, the single largest underlying fiscal consolidation achieved by any recent Alberta government. Because world output grew by nearly 3% a year during the same window, Alberta's real GDP performance still lagged global growth by roughly 2 percentage points. However, the services, manufacturing, and technology components of provincial GDP matched the OECD average once the direct oil and gas sector was excluded, indicating that diversification policies at least held the non-energy base steady during an external price shock that no provincial policy could avert. Crucially, the strategy of filling part of the royalty hole with stable tax revenue placed the public balance sheet on a trajectory consistent with long-run sustainability even in a low-price environment. Net debt did rise, to about 13% of GDP, but that increase was driven by recession-driven cash shortfalls and capital investment, not by permanent program cost escalation. By contrast, the late PC governments funded spending growth almost entirely from windfall royalties, allowing a structural deficit to emerge while resource prices were still high, and the Kenney administration reversed several of the very tax measures that had begun to close the gap, leaving the underlying deficit close to $8 billion even after 2 years of record royalties. The current Smith budget framework continues to project multi-billion-dollar shortfalls once commodity revenue retreats. On a world-calibrated growth basis, these governments did no better, and in most years somewhat worse, than the Notley term. Consequently, when difference in revenue effects and global cycle influences are stripped away, the 2015-19 government demonstrates the strongest evidence of fiscal prudence. It enacted durable tax reform that narrowed the structural gap, sustained growth-enhancing capital outlays, and positioned the province for eventual balance even in the absence of a royalty boom. No other administration in the past 2 decades combined comparable progress on the underlying fiscal balance with a macroeconomic performance that, adjusted for the global cycle, was at least respectable. On the available record, therefore, the Notley government can be argued to have pursued the most responsible overall policy.